All right, welcome back. In the last chapter, we looked at how financial institutions profit from interest rate spreads. Now we're going to tackle the second major pillar of their profitability, the entire world of fees and commissions. In this chapter, you'll see how these institutions build incredibly stable, predictable income streams, not by guessing where the market is going, but simply by being the house where the game is played.
So let's kick things off with a really fundamental question. As a retail trader, your success often depends entirely on making the right call on market direction. But do the big players, the institutions, operate under that same kind of pressure? Well, the answer, for the most part, is a clear no. And this is the absolute key right here. Their business model isn't built on being right. It's built on you participating. They've basically engineered a system where they earn money just because trades are happening, because money is being managed, because policies are being sold. They profit from the flow, not the outcome. So here's what's on the docket today. We're going to break this whole system down piece by piece. We'll start with that core principle, then look at specific models like brokerage and insurance, really dig into the mind-blowing power of scale, and then tie it all together. All right, let's get right into our first big idea. This concept is what truly separates the institutional mindset from the retail one. It's all about creating a business that's insulated from the day-to-day chaos and randomness of the market. And this slide, well, it lays it out perfectly. Think about it like this. The institutions are the ones who own the highway and operate the toll booths. They collect a small fee from every single car that passes through, day in and day out. It doesn't matter to them if the driver reaches their destination or gets lost. The retail trader, you're the one behind the wheel. Your success depends entirely on picking the right exit. Okay, so how does this whole profiting from activity thing actually work in the real world? Let's start with the most obvious one, that financial toll booth we just talked about, the small fees charged on every single transaction. You've definitely seen this before. It's that simple, small charge you pay your broker every time you buy or sell. With discount brokers, this flat fee model has become super common because it encourages more trading, more activity, and more activity means more fees for them. But here's the thing, that broker fee, it's just the tip of the iceberg. Every time you make a single trade, it sets off this chain reaction of other tiny fees. The exchange wants its cut for providing the platform, the regulator needs its piece for oversight, and of course the government gets its share through taxes. Every single one of them takes a slice, and none of them care whether your trade made money or not. So you might think these are just tiny, insignificant fees, right? Well, let's talk about scale. On an average day, just from those little transaction charges, the National Stock Exchange alone rakes in about 308 crores. Think about that. That's pure revenue from activity, and it comes in whether the market finished the day up, down, or flat. Okay, so transaction fees are one thing. But now, let's talk about a model that is way, way more powerful and predictable. Getting paid based on the total amount of money you manage. This is what we call assets under management, or AUM. Now, this chart reveals something really interesting about the mutual fund world. You'll see that as a fund gets bigger and bigger, regulators often require them to lower their percentage fee, the total expense ratio. So you might think, great, lower fees for me. But look at what's really happening. The fund house's main goal isn't just performance, it's gathering as many assets as possible. Because even a smaller slice of a much, much bigger pie equals a whole lot more revenue. Let's put some real numbers to this to see how powerful it is. Take a large mutual fund, say with about 50,000 crores in assets. It can easily earn 475 crores in fees per year. And this fee is just automatically skimmed off the fund's value every single day. It's a steady, predictable river of income for the fund manager that has nothing to do with their day-to-day performance. And this same idea applies to services for high net worth clients, what we call portfolio management services, or PMS. They might have a performance fee as a bonus, but the real key is the fixed fee. That manager is guaranteed to get paid a percentage of the total assets they're managing. The key takeaway? That fixed fee is guaranteed income for them, even in a year where your portfolio actually loses money. All right, let's switch gears a bit and look at a business that's all about sales volume and distribution muscle, insurance. So the way insurance commissions are set up is really interesting. They are what we call front-loaded. This means the agent gets their biggest paycheck right when they make the initial sale, a huge incentive to constantly bring in new business. Then they get smaller trailing commissions for keeping you as a client in the following years. And just how big is this model? Well, check out this number. In a single financial year, life insurance companies in India paid out over 60,000 crores just in commissions. That shows you that a huge chunk of what people pay in premiums is actually going right back out the door to fuel the sales engine. So we've looked at all these different fees, a flat fee here, a tiny percentage there. The real magic, the unseen force that ties all of this together and turns it into massive profits, is scale. It really boils down to this one simple, powerful idea. It's the principle of aggregation. A fee that feels like almost nothing to one person becomes a gigantic river of revenue when you collect it from millions of people or apply it to billions and billions of rupees in assets. And this chart, wow, this chart really drives the point home. Now look closely at the axis at the bottom. It's a logarithmic scale. That means each step isn't just 1, 2, 3, it's a jump of 10 times. So the real difference here is absolutely massive, far bigger than it even looks. That tiny little blue bar for a broker's one-time trade fee is practically invisible compared to the giant green bars representing recurring annual revenue from managed assets. That is the power of scale. Okay, let's wrap this up and pull all these different threads together to see the big picture of how this entire ecosystem really works. This table says it all, really. Just look down that last column. The broker, the fund manager, the advisor, the exchange, every single institutional player earns their fee whether the market goes up or down. Their income doesn't depend on direction. Now look at the last row. Only one participant's profit is entirely dependent on being right, the retail trader. And that right there sets us up perfectly for our next discussion. We've established how stable these fee-based incomes are, so the natural question is, what happens when you introduce powerful forces like leverage and extreme market volatility into the system? That's exactly what we're going to dive into in the next chapter.